Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, Kilroy Architectural Windows, Inc., New York's Window Company, New York Community Bank, Capital One Bank, Greenberg Traurig, LLP. Additional funding is provided by grants from Akron Gold Brothers, LLC, Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, Friedman, LLP, Gemini Real Estate Advisors, LLC, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knuckle Realty Services, Meridian Capital Group, M&T Bank, Muss Development, LLC, the Moynihan Group, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling, Stonehenge Partners, Urban American, W Financial Mortgage Fund, the Witkoff Group.
Hello, my name is Michael Stoller. Last week we started discussing where the industry experts projected 2010. So today we're going to continue that show, and my guest today includes Bruce Mosler, the co-chairman and CEO of Cushman & Wakefield, Steve Witkoff, the CEO of the Witkoff Group, Jim Kuhn, the president of Newmark Knight Frank, and last but not least, Joe Ficalora, chairman, president, and CEO of New York Community Bank. Mr. Kuhn, you were talking that, unfortunately, too many of my shows are myopic, and we only discuss certain things like Manhattan. So we want to really get your view. I know. Do
Well,
you
Des Moines,
wait?
Iowa, what?
No, you do go out of Manhattan. I do believe you're in, Quogue and other places. And Mr. Witkoff, you also go to Florida. You go to Montauk and other places. I'd like your view of the office market, not in Manhattan, but in the borough of Brooklyn.
You want to know about the office market of Brooklyn? That's
Yes,
an oxymoron. No, I mean,
Oh boy.
it's such a small market that I don't think it's relevant to the discussion of, when I talk about myopic, I'm talking about the rest of the country. I'm talking about non-supply constrained markets. New York, Washington, to a lesser extent, Boston, San Francisco, and West LA are supply constrained markets, difficult to build, et cetera. But the rest of the country exists.
But wasn't there Metrotech? Isn't there additional
Yes, there's
developments
Metrotech,
in
but
Brooklyn?
what's the office stock total in Brooklyn?
About 7 million.
Yeah, 3 buildings in Manhattan. So it's not you can't talk about a market for office space when it's that minute and have it meaningful in the overall macros.
So can we get to the discussion perhaps of Lower Manhattan?
Sure.
What do you think of Lower Manhattan today
think
for 2010? We're saying, where is the market? I mean, last week, basically, I heard these very optimistic approaches that everybody felt that the world is going to get a little better. I think Joe brought out the fact, both that you and Joe brought up the unemployment question. We also got to the bank situation, which will continue now. I really want to know, because I think Bruce brought out something at our meeting prior to the show. There are tenants who aren't going to take space in Lower Manhattan. There are certain problems. I mean, you're fortunate on your mezz loan at 180 Maiden Lane. The building Strzok recently renewed their lease. How do you see Lower Manhattan today?
I think Lower Manhattan has challenges. I mean, I think that the good news is that over the last 15 years, it developed into somewhat of a community when the old buildings were converted to multifamily. So it has a presence. But as many of the Wall Street firms moved north, they left pockets. And then the questions become, what happens when Goldman moves? 85 Broad's a large block coming on the market.
2.7 million square feet.
You have Merrill Lynch. I don't know, the jury's out on how much they're going to keep and not keep, but that's a big block of space. AIG moved. So I think you have a lot of challenges. It's gonna be a price issue. I do think that if a tenant, because as Midtown gets better, and as the landlords in Midtown decide they're not going to put out the big workloads, which I believe is what's going to happen next year. That's going to be the first consolidation. You'll go from 85 to 50.
First sign of an improving market.
That's correct.
For sure.
So when that happens, you'll have a definite price benefit of being downtown. I don't think it's going to be quick. There's a lot of space to absorb. But I think that there are certain types of tenants, whether it's the nonprofit industry, whether it's government, whether it's back office, that can go downtown for $32 a foot. And I think that there are going to be opportunities. But I don't want to paint a rose-colored picture for Lower Manhattan.
I would want you to put the good glasses on.
You know? I think there's some benefits for being downtown for a lot of tenants.
Steve, you owned property for many years downtown. I still remember the story of you shoveling snow in front of 156 William Street. Where do you see Lower Manhattan today in 2010?
No, I agree with what Jimmy said. It lags Midtown. It always does. But, you know, I think the jury's out on the office market in general. It always, you know, Michael, in the 90s, we were buying multifamily first, then hotel. They repriced themselves the fastest, and then office. Multifamily rallied a little bit in the last year. I think hotels are going to be the next thing to rally because, you know, if the economy comes back, then people will be traveling a little bit more and they'll reprice themselves. And then it's office. It's hard to buy office unless you have a long-term view of the economy. I mean, if you believe that that New York City is going to be a great city, and I think it will be, by the way, and I think this recent election was a good election, you know, if you're pro-business, then you got to start to buy office buildings, and downtown is where the bargains are.
I believe it perhaps was a year ago that Mr. Kuhn was my show with our friend Mr. Siegel, and you were saying, I'll see rents approach $100 a foot when oil approaches $100.
I said I thought oil would be $100 a foot before rents was $100 a foot.
What's your thought today?
I still believe that.
Where are rents today?
Well,
where are rents going to be in 2010? And that I'd like you to answer, and I'd like you, Mr. Mo,
well,
to answer.
Where? I mean, are you talking your best building in Manhattan, or are you talking your worst building in Manhattan?
I'm talking about for my audience, people want to know, you know, people take this show as an indication of where they should think prices are, what banks are doing in different situations. People really want to know the truth of what's happening.
I don't think you're going to see pure rent growth next year, but I do think you're going to see concession packages diminish, which will be the first sign of an improving market. There's not going to be enough positive absorption in the influx of tenant space to move the meter to a large extent. But I think because we believe that the market trial, as Bruce said, was the first quarter, I think landlords' fear factor is over, and I think, so as I said, the work letters will come down first. It will be 2011 before we see, I think, significant rent growth. So when you say where are the rents, there are 2004 rents today, more or less, and maybe next year it'll be 2004 and a half.
Bruce.
Yeah, I think a couple of points, Michael. Let's deal with a couple of facts about 2010. As I said last week, I happen to think that 2010 will be a year in which we begin to see the market recover as we see jobs come back. You can't disconnect the two because they're connected absolutely at the hip. Growth in market and net positive absorption is going to be connected to job growth in the city. I think we'll begin to see job growth in the city because, as I said last week, I think most businesses are operating at unsustainable levels in terms of their expense base being so low, having made so many cuts. I think businesses are going to gradually rehire as they begin to be more confident in their future. So, and I think business confidence is returning. I'm not saying that people are over the moon. I'm not saying that people are walking around as eternal optimists, but I think that what we're going to see in Manhattan is, Jimmy alluded to, we are going to see the concession packages with 15 million square feet roughly in that range of leases rolling over. We are going to see some movement. We're going to see some tenants relocate. We're going to see a number of tenants because of CapEx, meaning the capital required to relocate. We'll keep some in place, but we're going to see movement in the marketplace, and we're going to continue to see capital attracted to this particular marketplace, and major financial cities around the world, like London, like Germany, like Paris, and particularly New York, because the REITs have raised $28 billion this year. The sovereign wealth funds continue to look at opportunities here. Foreign capital, because of the currency, as I mentioned before last week, are going to look at New York, and they are already beginning to move. We saw DECA acquire an asset in Washington for a 6% cap rate fixed for a period of time. So I'm
the Europeans
cautious
are coming.
optimist.
There was an article the other day by the head of Sovereign Wealth Fund research at Templeton, Franklin Templeton in London, saying that the sovereign wealth funds are going back into real estate. They want to come into the real estate, preferably in the UK. They are worried about the currency in America. They're worried about the United States in general, and I think that's the situation. You know, we omitted last week, and I'm not going to let it be omitted, you know, Dubai World. You know, these people, you know, came out here. They got a lot of leverage. They got a lot of situation. We have a couple of buildings, you know, 1466 Broadway, which is half vacant, plus the land next to it. You have the leasehold at 450 Lexington Avenue. You have the two hotels, one which is going to be auctioned before anyway. What's going to happen? What effect is the sovereign wealth funds going to have on our market?
I don't think that Dubai World in and of itself has a dramatic effect on the United States. The question is, symbolically, what happens next, and is there other problems in other countries that affects the currency crisis as we had in '98 with the Russian economy? But that was a short-lived problem.
Yeah.
Abu Dhabi is going to step up, I believe, and mitigate part of the problem. There aren't that many U.S. banks that have a big investment there. Dubai World, to me, is like one big development company in New York at the moment going under. I think we shouldn't overlook the global issues that exist. The Chinese currency, to me, is more concerning than Dubai World, because you talked about Europe being on the mend, but what concerns me is, don't forget, the Chinese yuan is tied to the dollar. As the dollar drops, the Chinese yuan drops. What that does, it makes the European economy, their products, much more expensive. They don't benefit from the growth in China. So I think Dubai World may be, you know, a metaphor for what else is out there, but that in and of itself is a very, very small percentage of our problem.
2010, 2011, we have a lot of debt coming due. Joe brought it up last week. Steve brought it up on the CMBS, the collateralization. Who's going to take over? Who's going to finance this property, Joe?
Well, the bottom line is most of that debt was written at levels that are far, far beyond the current market.
That's correct.
So that's an old default. So we've had very little available for sale in the year 9. In the year 10, hopefully, more of that will become available at lower levels. So the good news, I think, is that there are plenty of good investors, both locally as well as funding from around the world, that wants to invest in New York. The bad news is that there's going to be a devaluation of most of the properties that come to the market. They're not going to come to the market at higher levels than they were.
That's correct.
They're going to come to the market at lower levels. And as a result, the rent rolls in those particular buildings will be altered down. So that's going to create downward pressure on the market because of the volumes of change that will occur. The thing that we don't know is when.
Right.
We have yes, Bruce?
No, just to, I think what Joe just articulated is very important to take another step, and that's that there's no question that we're going to see an adjustment in pricing reflective of different cap rates. But what I think the good news, the silver lining in this, is that whereas there were people at one point suggesting that perhaps the commercial property industry was going to fall off the cliff, that's not going to happen. And what we've seen in critical markets is that the pricing adjustment will be less profound, less, I think, painful than some people thought at a given moment in time. So if the cap rates adjust to 7s or 8s, or in some cases 6s, which we have some track record for seeing already, that's an indicator of value. And the value proposition that we're looking at, that we are trying to attempt to put a placeholder on, is going to be better than could have been.
In 1948, Jim Kuhn was born.
Oh, great. Thanks, everybody.
What do you want? No, come on. We do that on Building New York also. 1948, you're born and you live in Stuyvesant Town. What effect? Steve Witkoff has bought apartments.
1964.
I know. Oh, okay.
That would make me 76.
No, wait. I don't want to get. Okay, I don't want to get to the age situations. Okay, Fickalore is older than all of us. Okay, no. But here's my question: Stuytown. It's a question. There aren't answers over there. There's litigation. There's situations. Let's look at this. You're a buyer. You were a major buyer in the 90s of buying rental apartment buildings. You might come back to be a buyer. What effect is the Stuyvesant Town ruling going to have with regard to valuations or lending in 2010 and 2011? Any ideas?
It will definitely affect people that are currently with J51s in place and have adjusted their rents along the way. How many of them are there? I don't know.
I mean, there were only 9 tenants who brought the litigation in Stuytown.
Right.
So you're sitting in a situation over here, and I've already seen it in my story a couple weeks ago on my show was, I'm on 1010 Wins, and there are certain advertisers who've been on 1010 Wins for 22 years and 30 years, and these are attorneys who make a living by litigation.
Right,
This is the situation. 1-800-LAWYER. The letters are already being put up on the Upper West Side under these doors, and someone said to me the other day, the Belnord. Certain people are paying $45,000 a month for the rents in certain of those large apartments. That was a J51. There's a situation. How does a bank, how does an investor look at a deal? I mean, you're not going to pay the same amount now that there's a question up in the air, are you?
No, look, I get paid to take risk. I think bankers generally don't. So that kind of court ruling is going to have a pretty chilling effect on the financing market out there, I would think. On the other hand, my own prediction is that at Stuytown, whoever takes that property over, or if it gets re-equitized by Tishman, there's going to be a deal made with the tenants. And they're going to become ultimately buyers at much cheaper levels, but buyers of those units. And then that's going to change the whole complexion all over again. So,
Joe?
Well, I think the ruling only affected rent changes for 2 categories. People that were earning over $175,000, and when the rents themselves went over $2,000. So there are plenty of buildings with J51s all over the city that don't fall into those categories.
Michael,
Belmont, of course,
think
will.
You have to listen to what Steve said. He's paid to take risks. As long as I can remember in the real estate industry, multifamily, rent-stabilized, rent-controlled apartments in New York have always had hair. It didn't matter whether you were talking about doing an evict versus a non-evict program. Every deal, the tenants signed no-buy clauses. They litigated. This has been going on forever. And you know what happens? Some guys do okay. Some guys don't do okay. Ultimately, the tenants do great. So I wouldn't dwell too much with all the problems we have on this one issue. This is another risk in New York that you have that will somehow move on from it, and somebody will adjust their pricing levels, and somebody will own these complexes, and we'll move on. What's more important is the health of the economy of the city, not one individual project. I do want to add one thing, though, going back to what we talked about before. One of the very ironic benefits of the problems in the financial sector as far as refinances go and as far as available financing go is that you now have 2 sets of candidates that own buildings in New York. You have the candidates that have financial problems, can't refinance, don't have the capital to put into the buildings, and tenants won't go there today. You take those buildings out of the equation, and you look at a Bank of America building that Durst built, or an Empire State Building where Malkin put all the money into the sustainability of the building, or the Rudin family, and you go on and on. They're going to get the tenants, and therefore the real vacancy, I think, on a short-term basis, will be reduced by the amount of buildings that tenants want to go to. So we're going to have a 2-tiered market.
I think you're 100% right. I mean, the buyers who purchased buildings in 2006, 2007, who are undercapitalized, who went to the CMBS, who don't have money to pay TI, who don't have money to pay brokerage commissions. These buildings people aren't running into. Your brokers and your brokers aren't taking them to there. They're going to buildings where it's well capitalized. In the same manner, people aren't going to Liberty Point Bank because the FDIC may take them over. I mean, in 2000, let's remember, 2009, 124 banks have been taken over. The prior year was 23. The prior year was 4. I mean, we're going back to 1992 numbers, the situation. You know, we haven't seen the worst yet in certain of the banks.
Yeah, there's no question there are going to be in 10, 11, 12, hundreds and hundreds of banks that are going to, in fact, fail. And if the accounting rules are not modified reasonably, that number could even be significantly higher than that. And the impact on the overall economy cannot be good if, in fact, the source of funding is, in fact, dwindling.
I also don't want to underestimate the small business problems today. And we're talking about the big corporations, and that's where we make our living. But we have 44% more small business bankruptcies this year than last year. And if health care reform ultimately comes out in a particular manner, it's going to have a huge impact on small businesses.
Well, but in the macro picture, Jimmy, talking about healthcare reform and its impacting the economy, I think you have to go to broader issues. And when you look at the broader issues, we probably have to look at reforming Social Security. People are living longer. You're talking now about the debt on this country long term, and that macro picture type of thinking, I think, leads to a series of issues that the government has to and will deal with, healthcare being the first.
But Steve said before that New York was okay because crime was low and taxes were important. And if you look at the tax implications of what's going on, coupled with the cost to small business of healthcare reform, if not done properly, will have an enormous impact on small business. And as much as we make our living on the large tenants in New York City, 85% of the companies in New York are small businesses.
No question. And small business has a significant role in the economic health of our country. No question. And the challenge is, right now, small business can't get loans. Small business, it's the burden right now on the recovery is twice as much as it ought to be. Absolutely. Because we don't have small business functioning.
And Bruce, we do in the same manner of you saying small businesses can't get loans, small owners of properties are having difficulties in getting loans also. And then the other discussion that Joe brought up prior to the show was the discussion with Fannie and Freddie. Fannie Mae and Freddie Mac have been doing lots of apartments. At one time, they represented maybe 30% of the financing. In 2009, they represented, 67%, 70% of the multifamily apartments. What's going to happen in 2010, 2011 with Fannie and Freddie?
Well, it's very much unknown because Fannie and Freddie are in receivership. There is no question that there is no new money to fund Fannie and Freddie. The only money that they have is what, in fact, they're recycling. So they're losing a huge amount, and then they're refinancing with whatever they have, existing product in the city and around the country. Fannie and Freddie is not a focused lender only in the New York market. They're a national lender, and they, in fact, have a serious drain of resource.
You and I have discussed this, and I know Steve Witkoff has also discussed this. Fannie and Freddie is supposed to be providing affordable financing for affordable apartments. How did Fannie and Freddie, in 2009, they financed the $152 million luxury apartment houses. How does the mandate of Fannie and Freddie go into other areas like that? How's that happen?
It makes no sense. The biggest mistake that was ever made was the decision to let Fannie and Freddie, which were government entities, become public companies. You can't be public and be a government entity. They had a price of funding advantage over the rest of the market, and they were in fact making money as a profitable company because they became publicly traded entities. Big mistake. Well, they're no longer public, and the fact is that they are in receivership, and that has to be dealt with. It has not been dealt with, and they are the only source of funding for 1 to 4 family, because there is no structured debt available today for 1 to 4 family housing. So the only source of funding other than a bank is Fannie and Freddie. And Fannie and Freddie, as a result of mandate from the Congress, is refinancing huge amounts of their own portfolio. If they refinance their portfolio, they don't have a new
Aren't they
dollar.
waiting for the securitization? They need a securitization market themselves.
Well, they
'Cause
are a
if
securitization
They're securitization market, but if they don't have an efficient securitization market,
Oh,
it's the same
absolutely.
situation that we're having with the regular CMBS market.
But Michael, just because I think we're headed down a certain pathway
And
right
we have
now,
about a minute left.
Yeah.
No, but I think we should come back to a couple things and put them in perspective. The final story isn't written yet on healthcare, and I think Jimmy's right that there's a profound impact to our economy, to our city, to the country in general. But the script has not been, I think, submitted. We're going to healthcare without tort reform, in one person's opinion, mine, is going to be a challenge. But there's a lot more that has to unravel here. In general, I think we're moving in the right direction. We're answering more questions than questions that are being opened up in terms of the economy itself. There's undeniably further to go, more questions that are unanswered. But when you look at where we are, '08 versus '09 versus where I think 10 sits, there's some reason for optimism.
So I think in conclusion, there is optimism for 2010. It's going to be a little tough in 2010, but things are looking brighter. And I'd like to thank the four of you for the past 2 weeks of your appearances on your views of the state of the market for 2010. I'd like to thank Bruce Mosler, Steve Witkoff, Jim Kuhn, and Joe Ficalore. Next week, we're going to have some residential developers. There is that subject of residential developers, Steve.
Oxymoron, right?
An oxymoron. Talk about where they see the market in 2010. See you next week.
Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, Kilroy Architectural Windows, Inc., New York's Window Company, New York Community Bank, Capital One Bank, Greenberg Traurig, LLP. Additional funding is provided by grants from Akron Gold Brothers, LLC, Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, Friedman, LLP, Gemini Real Estate Advisors, LLC, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, M&T Bank, Muss Development, LLC, Des Moines Group, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling, Stonehenge Partners, Urban American, W Financial Mortgage Fund, the Witkoff Group.